Hi, South Bay neighbors. Welcome to your South Bay specific real estate housing market update for the month of August 2024. We're going to do things a bit differently today. I'm going to give you the same old stats that we have updated for this month, but then afterwards, I'm going to give you more information, both on what's been happening in the South Bay over the last year and a half, but also with interest rates coming down, what we expect nationally to happen in home prices, and especially here in the South Bay moving forward. So let's get into the information. Last month, we had 358 homes closed sale, 487 new listings, and 244 pending sales. All of those numbers look pretty standard and unchanged from last month. So we're seeing that trend of pending sales decrease just a bit each month. And now months of inventory in the South Bay total is up over 3 for the first time since 2019. That means that if no new listings came to market, that it would take 3 months to buy up all the current inventory. And now if you take a look at this graph here, you can see this is the months of inventory in the South Bay over the past 5 years. And you can see we were just over 3, around 3 in 2019. That was a seller's market. Then 2020 hit and 2021 hit, and we had barely any inventory and home prices were skyrocketing. Then about mid-2022, when interest rates rose up, the months of inventory came back to the normal level that it had been for a while. Still a little low, but much better than it was in the previous 2 years. And then now it's slowly been trending up in 2024. Now, we've seen this, and I've spoken about it quite a bit on my weekly new listings in Redondo Beach show about homes that are over 3,000 square feet in Redondo Beach. If you take a look at the following graph, which is the same graph, it's months supply, but for North Redondo Beach and homes over 3,000 square feet, you can see since 2019, we've been under 4 months for most of the time. But then sometime here in 2024, those homes over 3,000 square feet started sitting. And we've seen this and we've been tracking this week by week on our new listings in Redondo Beach show. And it's pretty jarring to see what's going on this year in homes over 3,000 square feet, as we're up over 7 months of inventory. So we've got a lot of inventory there and a lot of homes not selling in those price ranges. In fact, we've seen that most homes are capping out over 3,000 square feet, selling under 2.5 million or so, whereas the homes that are listed above that just aren't selling right now. Moving forward, it is important to note that 4 months to 6 months of inventory is a healthy appreciating market. We've been under that for quite some time, which is why at certain points we've had really spiking prices in the area. But 4 to 6 is normal healthy. Over 6 is when you get into a depreciating market. So this 3.1 month supply is still low and still a seller's market in terms of not having enough houses to purchase. Now, the average days on market is 27 days right now in the South Bay, and the median days on market is 12 days. That means half of all homes that are selling in under 12 days. The market is still hot. We still only have 3 months of inventory, and most homes are still selling quickly. You can see that as closing price as an average based upon the original list price, where the average closing price is 99.6% of the original list price. So some homes are selling for over list price, some homes are selling for under list price, but it ends up averaging about 100%. The average sale price this year is 1.66 million, where the average sale price last year this time was 1.44 million. And that gives us an increase year over year of over 14%. Now, the last couple months, we've had an increase year over year of about 0, 2% up, 2% down. Well, last year in July, the statistics, the average sale price had a dip month, whereas this year in June, the average sale price has an increase this month. And you can see that here in this graph of home prices over the last 5 years on a rolling 3-month average in the South Bay. You can see that generally speaking, about halfway through the year, we see a little bit of dip in prices almost every year. Obviously, 2019 was about steady, but then 2020, we saw a massive increase, 2021, massive increase. And then 2022, the second half of the year when interest rates rose, we see that huge dip. 2023, we recovered that value. And then 2023, about halfway through the year, we also saw a dip, but a little bit smaller. And now we've recovered and exceeded that value. And since we didn't dip as much moving forward, we might expect to continue this appreciation, but I'll get into that in terms of interest rates here in a few minutes. Now, it's important to note that that's the South Bay in total. different areas and different markets within the South Bay, even within one city, are showing different things. And that's why the market's a bit confusing to some. So let's take a look at North Redondo Beach specifically. So if you're looking at 2-bed and 3-bed townhomes in North Redondo Beach, take a look at this graph. You can see we generally have an increase. We have a high increase the first half of 2022. Then we come back down the second half of 2022. In 2023, we stay about even, up and even, and then we go up now here in 2024. So if you take us from the first half of 2022 to now the second half of 2024, you can see a slow rise if you draw a median line there. But at the same time, now let's look at the homes that we just talked about in terms of the 3,000 plus square foot homes in the same market. Now, in the same market, the 3,000 plus square foot homes saw an increase, but ever since the second half of 2022, you actually would have a depreciating line in those homes from the second half of 2022 until today. You see a drop in 2022, quick recovery, but then another drop, and then they've remained about steady since then. And right now we see 7.1 months of inventory in those homes. So you might expect here in the next couple months that number to go down there at the end as well a little bit. Well, what does this all mean? Well, it means we have a very unique and interesting market, and depending on what type of home you're looking for, you may be getting a great deal comparatively to 2 years ago, or prices might still be going up on you. One theory as to why that is happening is because first-time home buyers, the millennials who have kind of been sitting on the sidelines over the past couple of years with high interest rates, there's still more buyers there than there are sellers' homes for them to buy. And first-time home buyers are usually buying those 2 and 3 bedroom townhomes, and that's why those have continued to rise. However, higher interest rates have kind of put a pause on the move-up buyers. So those potential buyers that are selling those homes to the first-time buyers, the 2-bed and 3-bed townhome, are actually holding pat and living in their home rather than selling them, bringing more to market, and then purchasing that 3,000 square foot home. So there's less inventory for the first-time home buyers, and there's a lot of those because the millennials are the biggest group of folks since the baby boomers, and even bigger than those baby boomer generation. Also, the owners of those 2 and 3-bed properties are not selling their homes to move up to the 3,000 square foot. So they're limiting on one end the supply down here, and then also limiting the demand up here for those 3,000 square foot homes. Now, what will happen when interest rates change? Well, let's see. Let's get into that now. So this is all starting with the Fed decision on July 31st to maintain the target range for the federal funds rate at 5.25% to 5.5%. Now, their decision to maintain, along with certain data that we'll get into, got the market really hot and heavy, where interest rates came down from when they were bordering 8% at a certain point this year, and then 7.5% for most of the year. Now we're under 6.5%. So with things changing, with interest rates coming down, this is what Mark Zandi, the chief economist for Moody's Analytics, says. He says the Federal Reserve stuck to the script, holding monetary policy unchanged, but strongly suggested a rate cut is likely in September. The inflation data must cooperate for the Fed to follow through, but all indications are that it will. Global investors are cheered by this. Stocks are up a lot and bond yields are down, as they should be. The economy is set to soft land. So what this means is, yes, we expect interest rates to come down. However, there's going to be more data coming out next month. And depending on that data, the course may be changed, but right now that data is expected to continue the lower of interest rates. Sam Katera, chief economist of Freddie Mac, says mortgage rates declined to their lowest level since early February. Expectations of a Fed rate cut coupled with signs of cooling inflation bode well for the market, but apprehension in consumer confidence may prevent an immediate uptick as affordability challenges remain top of mind. Despite this, a recent moderation in home price growth and increase in housing inventory are a welcome sign for potential home buyers. So this is great. This is all good news. Moving on, the U.S. Bureau of Labor Statistics states that the unemployment rate rose by 0.2 percentage points to 4.3% in July, and the number of unemployed people increased by 352,000 to 7.2 million. These measures are higher than a year earlier, when the jobless rate was 3.5%, and the number of unemployed people was 5.9 million. So these things work together, right? High unemployment rate means usually inflation data is low, which means lower interest rates. So if you look at this graph here, unemployment rates rise again. And as you can see, the unemployment rate in 2020, all throughout the end of 2021, was in this red and orange area, which is higher than the average between 1948 and 2023. High unemployment rate, usually low inflation, usually low interest rates. And now we've had really low unemployment since the beginning of 2022 all the way until today. Still, it's low unemployment, but it is trending upwards. And as it's trending upwards, the Federal Reserve is following suit and lowering interest rates. Lawrence Yun, the chief economist at NAR, says mortgage rates are plunging on the news of weak job growth and rising unemployment. And then you can see on this graph that mortgage rates dipped to the lowest level since February. You can see since February, or this graph has May, but 7.5 is where we were for quite some time. And since then, we've been slowly decreasing, staying steady just above 7, between 7 and 7.25 for a while. But now this last week, boom, we're dipping. And the Fed has also come out and said, as we saw earlier, that they believe they're going to drop interest rates again here in September. Lawrence Yun, the chief economist at NAR, says there's a large pent-up stored demand that could be released into the marketplace when conditions improve. Lower mortgage rates and more inventory. Inventory is finally turning up about 15%, and that is likely an early leading indicator that we may finally see more home sales as conditions improve. This is great. I've personally seen this. So the millennial generation is the largest generation since the baby boomers. And for about 1.5 years now, since the second half of 2022, many of millennials have paused their home search. So there is a large portion of pent up demand where those folks that couldn't buy or decided not to buy it in 8% or 7.5% have sat on the sidelines, and they're ready and itching to jump back into the market. Also, home owners have the same decision to make. When interest rates come down, is that worthwhile for them to purchase their next home? Doug Duncan from Fannie Mae says listings have trended generally upward of late, suggesting to us that a rising number of current homeowners can no longer put off moving. Yes, and now if interest rates continue to improve, that'll definitely work out. But as you saw earlier in this video, the month's supply for most homes, for all homes in the South Bay, is still only at 3.1. So yes, listings have trended upward. However, the buyer demand has remained high enough to still buy them at a rate to keep that months of inventory low. But I thought this was an interesting stat for everybody. This is a graph showing that more than half of homeowners need rates under 6%. So this is 52% of homeowners said that they would be comfortable purchasing a home if the interest rate was less than 6%. Obviously, a smaller percentage, less than 5%, smaller percentage, less than 4%. So what this is telling me is that 52% of homeowners out there are ready to either sell and purchase or purchase. This is more buyer demand coming into the market, but also these are homeowners. So a lot of this is also seller supply coming into the market, which will free things up as well. So here is a similar poll that was taken by Bankrate showing homeowners are less likely to sell due to rates. So which mortgage rate, if any, would you need to be comfortable to sell your home this year? And as you can see, the bottom line is the most important. 42% of homeowners said the rate doesn't matter, I'm not selling. 35% of homeowners said they would sell at 6%. So the way I view these past two slides is we have a lot more buyers than sellers still. 52% of homeowners said they would buy if rates decreased. However, only 35% of homeowners said they would sell. So that means less inventory is coming to market and more buyer demand is coming to market as rates decrease. And that's on the home ownership side. Obviously, the first-time home buyers don't have a house to sell. So they're just going to be entering the market without a home to sell. So we should still see this demand outpacing supply even when interest rates come down. Greg McBride from Bankrate says the hopes for lower interest rates need the reality check that lower doesn't mean we're going back to 3% mortgage rates. Mortgage rates are 7% now, and the best we may be able to hope for over the next year is 5.5 to 6%. I might add to that the best we may be able to hope for the rest of our lives is 5.5 to 6%. 3% mortgage rates were the lowest rates in the history of the United States. It's, in my opinion, not sensible to expect to go back and set records again. Historically, rates have been in the 5, 6, 7 range, and that's where I would expect them to continue to be. It would be great if we saw 3% and 4% again, but the best we may be able to hope for the rest of our lives is 5.5 to 6%. It would be unfair to expect them to set new records. However, Mortgage News Daily says it's very fair to ask where we go from here. There is never a crystal ball, and the lessons of early 2024 should be kept in mind. Additional improvement in rates will require a fresh supply of downbeat economic data, and there aren't many big ticket reports on the horizon. Beyond the next 2 weeks, the next month and a half could be particularly volatile. As it stands, though, the market is second-guessing the Fed's decision to hold steady this week and wondering if they'll be playing catch-up in mid-September in the event economic data keeps trending weaker. So what this is saying is that when economic data trends weaker, interest rates tend to decrease. So if the unemployment rate continues to rise, then there might be more drastic drops in interest rates than the Fed is even stating that they will plan to do in September. For home buyers and sellers, today's data points to a more rapid pace of mortgage rate declines than previously expected. The daily average 30-year fixed mortgage rate fell from 6.6 to 6.4 following the release of the jobs report. However, economic data is always noisy, and this is only 1 month of data. The Fed will have a hard time looking past this, but they may want more solid evidence from another month of data to avoid panicking. Once again, this is Redfin stating that the Fed holding pat this month and not dropping things might have been a smaller move than they should have made. And next month, if data continues to trend negatively, they may have to have a bigger jump and drop rates more than they expected to catch up. So Bill McBride, who seems to be in that camp of the interest rates are going to drop camp, he says, we now expect consecutive 25 basis point rate cuts in September, November, and December. The slowdown in job growth in July report likely overstates the decline in the underlying trend. But if August unemployment report is also weak, then a 50 basis point cut will become likely. Cool. We don't know how the data is going to come out. This is why we will continue to watch it. But yeah, if this happens and in September we see a 50 basis point rate cut, that takes us from low sixes to high fives. And I'll tell you what, that's a pretty aggressive expectation, and we'll see what happens in the coming months. Lastly, Bankrate states, if you're ready to buy, now might be the time to strike. Home prices have been rising primarily because of a long-standing shortage of homes for sale. That's unlikely to change. And if mortgage rates do fall below 6%, it's possible buyers would enter the market en masse, further pushing up prices and resurrecting bidding wars. This is exactly what I expect to happen. If we see rates in the fives anytime soon, I expect the market, especially here in the South Bay, to get absolutely flooded with buyers. We may see more sellers, but we will see more buyers and sellers. I would expect we go right back to 2020 and 2021 situation where we have 10 offers, 12 offers, 15 offers on every property. If we see interest rates in the fives again, it could get wild. I'm excited to continue to watch this. I'm excited to bring you this information. If you did like this information, please take a moment and hit the like button below and subscribe. And also leave a comment below if you'd like me getting more into economic data in this market update, because usually they're a bit shorter and this one was a bit longer. Obviously, I'm Garrison Comstock. I'm the owner of Garrison Team Real Estate here in the South Bay in Redondo Beach. So if you have any questions, I would love to be your real estate guide. If you're looking to position yourself to get ready to purchase should the interest rates hit a certain level for you, or even find out how much you can afford at today's rate of 6.4 versus tomorrow's potential rate of 5.99, reach out and I can help you with that. As well as sellers, if there's a magical number that turns you into a seller, go ahead and reach out, because it's now when you want to position your home to sell and decide on what the strategy will be to hopefully sell first, buy second, or buy first, sell second, or use a bridge loan or a HELOC or something to make that transition as stress-free as possible. I'm happy to help. We do this all the time. Happy to be your real estate guide. Thanks again for watching. Make sure to like and subscribe, and I'll see you soon.